Welcome back guys to another Zero DTE video, and today Ernie's going to be talking about the influence of volatility, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy guys.
My question that I ask about the validity or the efficacy of doing this exercise of looking at the market in the past through the replay facility of TradingView, I guess I'm saying, should I waste my time on that, or should I spend my time on that?
It's teaching you the behavior of the growth of Butterfly's P&L over the period of a day, and also in the context of that particular market. And it will help you understand how to behave in low volatility markets and high volatility markets, and how to behave in the first third, second third, and last third of the day.
Okay, great. I like that. Now, the other aspect of it is you have to put in the mix the flavor, another spice, so to speak, of trying to remember what that market structure is, and as defined by the volume profile plus the VIX of that particular day or moment or hour or whatever, plus the range. In order to get totally informed about that market, you have to have 4 or 5 of those things going at the same time in your head.
So ultimately, it comes down to volatility, how much exposure or how little exposure you want to put out there. And I've often said that there are basically 4 edges that we're trying to exploit: the change in time, the change in price, and the change in volatility. The volatility part will essentially determine our total exposure to risk, as well as our total capital size. It'll determine on any given day how big we should go in or how small we should go in. Time is built in. We know that the reason why we're choosing zero DTE, because our knowledge of the exponential decay of premium dictates that last day has the greatest opportunity to grab as much of that premium decay as possible in the shortest period of time. We also know that that can even be further broken down, that zero DTE day, down to the individual day, and break that up into segments too, and understand what the behavioral changes are from morning, afternoon, and closing session, and then all the other things that can influence that on certain days, and how it influences it. So all of that knowledge is really easy to understand and categorize. Simply resolves down to how big or how small we make our trade, what we should expect in low volatility as opposed to high volatility, and what goes in between, how we should behave. Should we behave quicker because profits are more fleeting and sensitive to price movement, as in low volatility? Or can we expand our risk and act slower, more resolute, and expect bigger things in high volatility? So that changes our behavior based on very well known and easy to identify things, right? Now, when we make those decisions, the individual decision of holding or folding, we can bring into it other pieces of information that will help us make that decision. The number one would be, what is our tolerance zone that will adjust according to the day or the time of day and the amount of volatility? So in other words, in low volatility, our tolerance zone starts small. In high volatility, it starts wide. In low volatility, it gets small faster. In high volatility, it gets small slower, right? That's our tolerance zone, right? We know those things. They're not hard to figure out. It's a little hard at first to understand that's what's happening. But when you're in the moment, in that day, it's not going to change from high or low volatility. It's about the same. When we're in low volatility, we act a certain way, and we're probably going to act that way for the next few weeks, few months. When it's in high volatility, we'll act a slightly different way, which is essentially the same, only taking in a little bit more because we can afford to, because options are cheaper and gamma is flatter and it's easier, right? So we've got that part down. And we know that putting an out of the money fly makes sense because of going with the trend is definitely giving us a slight edge. Asymmetry is an edge because there is positive expectancy in low probability, high potential return strategies as opposed to high probability, low return strategies. Again, a small edge. So trading in the trend, trading asymmetrically. Plus, we also know that asymmetry gives us additional benefits, and those additional benefits are capital preservation. And these are tropes that are repeated in the foundation of all hedge fund managers and professional traders. You must not draw down. You must focus on low volatility of your returns, and at the same time try to be open to the maximum potential profit and return on your capital. So an asymmetric position is the only thing that gives you that. They're all fitting together. All this stuff fits together.
Thanks for watching, guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks, guys.